Welcome to our deep dive into investing.
Sounds fun.
We're using excerpts from Michelle Kagan's Investing 101.
Oh, great choice.
Yeah, it's perfect for getting a handle on the basics
Yeah.
and building some confidence, for navigating the markets.
It's a fantastic foundation.
Okay, so should we start with interest rates?
Sure.
Kagan really emphasizes how the Federal Reserve, the Fed, plays such a huge role.
Right.
It's not just about like what you see in your savings account.
No, not at all.
It's bigger than that.
Right. And what's so interesting is how the Fed's decisions on those rates really have this ripple effect through the whole economy.
Oh, okay.
So like when the Fed raises rates, borrowing becomes more expensive, especially for companies.
Okay.
And that impacts their growth, even their stock prices.
Oh, that makes sense.
Yeah.
If they have less money to invest
Yeah.
or even pay dividends because they're paying more to borrow, their stock might not look so good anymore.
Exactly.
Yeah.
On the other hand, when the Fed lowers rates, it can really stimulate the economy and make stocks more attractive.
Compared to, like, bonds.
Exactly, compared to other investments.
So it's kind of this balancing act.
It is.
Kagan also mentions how the Fed doesn't just make
Right.
decisions randomly, right?
Right.
They're looking at all these economic indicators.
Exactly. They're like vital signs
Okay.
for the economy.
Yeah.
Kagan highlights some key ones
Mm-hmm.
like GDP, CPI,
Oh, yeah.
the unemployment index.
I remember learning about those
Right.
back in school,
Mm-hmm.
but it felt so,
Abstract.
yes, abstract. So how can understanding those actually help you
Yeah.
make better investment decisions?
Well, it's about connecting the dots.
Okay.
For example, if you see strong job growth, it suggests companies are doing well.
Right.
Might be a good time to consider growth stocks.
Oh, interesting.
But if consumer confidence takes a dip, it suggests maybe a more cautious approach.
Like you're getting a sneak peek.
A little preview.
Behind the curtain
Yeah.
to see what's coming next.
Exactly.
I like that.
Yeah.
Okay, so we've got interest rates and these economic indicators.
Right.
But what about the ways you can actually invest your money?
Yeah, there are so many.
So many. Kagan talks about bonds, mutual funds, ETFs.
Each of those has its own personality, you could say,
Okay.
and its own risk profile.
Right.
Bonds, for example, offer that fixed income stream.
Yeah.
They're often seen as less risky than stocks.
It's like a loan, right?
Yes, like a loan.
To a company or the government.
Yeah.
They promise to pay you back.
Right.
With interest.
Exactly.
And what about mutual funds? Everyone talks about those, but I'm not sure I get how they work.
They pool money
Okay.
from multiple investors
Right?
to buy a basket of stocks or bonds or other assets.
Ah.
So you're diversifying without having to buy all the individual stocks yourself.
So it's like having a professional chef create a delicious, balanced meal for you,
I like that.
instead of me trying to cook everything from scratch.
Exactly.
Then there are ETFs. Those seem kind of similar.
Yes, they are similar.
To mutual funds, what's the difference?
ETFs, exchange-traded funds,
Right.
also offer diversification, but they trade on stock exchanges,
Okay.
like individual stocks.
I see.
So that makes them more flexible.
Got it.
You can buy and sell them throughout the trading day.
So more flexibility than a mutual fund.
Exactly.
Okay, now let's go back to stocks for a minute.
Sure.
Because Kagan breaks down all these different types of stocks.
Yeah.
Blue chips, growth stocks, income stocks, even penny stocks.
It's a lot to take in.
It really is. It's like walking into this giant candy store
Yeah.
and trying to choose.
Right. Understanding those distinctions
Yeah.
is key. Blue chips, think of them like the reliable, well-established companies.
Oh?
They often have a history of stable earnings and dividend payments.
Yeah.
So those are your Coca-Colas, your Johnson & Johnsons.
They sound like a solid choice. Maybe not the most exciting, but dependable.
Right. Then you've got your growth stocks.
Okay.
These are the companies that are expected to grow at a faster pace than average,
Like Tesla.
or Amazon.
Exactly. They're often in newer industries or with those innovative products.
Okay.
But they can be riskier.
Yeah, higher risk, higher potential reward
Exactly.
than there are the income stocks.
Yes, as the name suggests.
Yeah.
They focus on providing regular income through dividends.
So it's like
Yeah.
getting a regular paycheck
It is.
from your investment.
Exactly.
And then the penny stocks, those always feel a bit like gambling.
They are highly speculative,
Okay.
often very thinly traded,
Right.
meaning it's hard to buy or sell them quickly
Yeah.
without affecting the price.
Yeah.
And they can also be targets for scams.
So Not for the faint of heart.
Definitely not for beginners.
Now, Kagan also explains how companies get listed on those exchanges, like the NYSE and the NASDAQ. Right. It's interesting how that happens.
Yeah.
It's a whole process.
Yeah, going from privately held to offering shares publicly. So the NYSE, that's the older, more traditional one?
Yes. Very strict listing requirements.
Okay.
And then the NASDAQ, that's known for tech and growth companies.
Right, right.
Kagan also highlights the SEC's role in regulating the markets,
Oh, yeah.
protecting investors from things like insider trading.
So there are rules and oversight
There are.
to keep things fair.
Absolutely.
Now, what about the different investment strategies? Kagan mentions value investing, which is what Warren Buffett's famous for.
Right.
But also growth investing and technical investing.
Yeah, each offers a different approach.
Okay, tell me more about that.
So value investors, they're looking for those undervalued companies,
Right.
ones they believe the market is overlooking.
Like they're hidden gems.
Exactly.
Yeah.
Then you have your growth investors. They're chasing future potential, looking for companies that are poised for rapid expansion.
Right.
And then your technical investors, they rely on those charts and patterns
Oh, yeah.
to identify trends, momentum in the market.
Okay, and then there's short selling.
Ah, yes. That's a more advanced strategy.
Yeah, and I don't really get it. Isn't the goal to make money when prices go up?
Well, with short selling, you're borrowing shares, selling them, hoping to buy them back later at a lower price.
Oh, so you profit from the difference.
Exactly. It's high risk, high reward.
Definitely not for the beginner.
No.
Okay, now, Kagan doesn't just focus on stocks, right?
No, there's a whole world out there.
In Investing 101, she also talks about real estate, currency trading, commodities.
So many possibilities.
It really is. It's a whole universe of investment opportunities
It is.
beyond the stock market.
Absolutely.
So real estate, that can be a great long-term investment.
Yes, but it also often requires a lot of capital.
Right.
And it comes with management responsibilities.
Yeah, for sure. Currency trading, that always sounds so intense.
It is.
Betting on the fluctuations between different currencies.
Yeah, you have to understand the global markets, economic and political factors.
Right. And commodity trading, like gold or oil.
Requires a deep understanding of supply and demand.
It's like trying to predict the weather,
Exactly.
but for the financial markets.
Yes, it is.
Okay, then there are options and futures. Those
Those derivatives.
Right.
They derive their value from an underlying asset.
Oh, okay.
They can be really powerful tools,
Yeah,
but require a high level of expertise.
got it.
Kagan gives a good overview,
Mm-hmm.
but if you're interested in those, you really have to study them further.
Yeah.
They're complex.
So it seems like in the investing world, knowledge really is power.
Absolutely.
Now, let's move on to something a bit more practical.
Okay.
Investing for education and retirement.
Ah, yes, those big life goals.
We are. And it can feel so overwhelming.
It can, but Kagan breaks it down. Yeah.
In a very approachable way.
Yeah.
She talks about 529s for college savings.
Right.
ESAs for education expenses at any level, and then the 401k
Yes, for 401k.
for retirement.
And she talks about
Yeah.
how important those employer matching contributions are.
It's like free money.
Yes.
Can't beat that.
It seems like a no-brainer to contribute.
It really is.
Enough to get the match.
At least that much, yeah.
Now, Kagan also emphasizes the importance of really understanding your risk tolerance
Absolutely.
and setting those clear investment goals.
Yes, without those,
Yeah.
you're kind of just drifting.
Yeah,
Building that well-balanced portfolio is key,
right.
whether you're seeking stability or looking for that aggressive growth.
Now, finally, we get to learn from the masters.
Yeah, this is the fun part.
Investing 101 has all these insights from Benjamin Graham, Warren Buffett,
The legend.
Peter Lynch,
Yeah.
Jack Bogle.
It's a crash course in investing wisdom
Yeah.
from the best of the best. Well, I'm already feeling more confident just going through this overview.
That's great. So, ready to dive into those economic indicators?
Let's do it.
All right. Kagan says they're super important for understanding the market, the big picture.
Yeah. Let's start with GDP.
Okay. Gross domestic product.
Yeah, it's like the report card for the economy, right?
It is for the whole country's economy.
It measures all the goods and services produced.
Right. So when GDP is growing, generally that's good news.
Good news for the stock market.
Good news for everyone usually means a healthy economy.
Okay, so a shrinking GDP?
Uh-oh.
Not so good.
Could be a recession, might see market downturns.
Okay, makes sense.
Then there's CPI, or Consumer Price Index, that tracks inflation.
Inflation, oh yeah.
Which can impact investments in a big way.
Because that's when prices for everything just keep going up, right?
Exactly. It eats away at your purchasing power.
And Kagan says that rising inflation can lead to higher interest rates.
It often does.
Like we talked about earlier.
It's all connected.
It really is. It's like a web.
Now, what about the unemployment index?
Right. That tracks the percentage of people who are unemployed and actively looking for work.
So high unemployment, that means the economy's struggling.
Generally, yes. But Kagan also talks about job growth.
Oh, yeah.
As a positive signal.
More jobs, stronger economy.
Exactly. Businesses are feeling confident, expanding, hiring more people, and that can boost the market.
Kagan actually gives this really interesting example about how 9/11 really impacted consumer confidence.
Of course.
And had all these ripple effects through the market.
It really shows you how those real-world events have this tangible impact on the economy and investments.
It's not just numbers on a screen.
It's not. It's people's lives.
Speaking of consumer confidence, that's another big indicator, right?
It is. Measures how optimistic people feel about the economy.
So if everyone's feeling good, they spend more.
Yeah, they do. Businesses do well.
The stock market goes up.
It's like this self-fulfilling prophecy.
It can be.
You feel good, you spend, economy grows, you feel even better.
And round it goes.
Are there any other indicators she talks about?
Oh, yeah. She mentions housing starts.
What's that?
That measures new residential construction projects.
Oh, okay.
So if those are surging, could mean strong growth.
Yeah.
But a decline could suggest a slowdown.
Because building new homes, that creates jobs, right?
Absolutely. Uses a lot of resources.
Right.
So it's a positive sign.
Okay, so it sounds like keeping an eye on these indicators can really help you make smarter choices.
Absolutely. It's like having a little bit of insider knowledge.
Yeah. Okay, I'm ready to explore those different types of stocks now.
Okay. Which ones are you curious about?
Well, I always get confused by blue chip stocks and growth stocks.
All right, let's break those down.
Yeah.
Blue chip stocks, think of those as the A-list celebrities of the market. Household names, well-established, usually have a history of stable earnings and dividend payments.
So those are your
Coca-Colas, your Johnson & Johnsons.
Okay.
Solid, dependable.
Yeah.
Not always exciting.
But reliable.
But reliable, exactly.
Okay, and what about growth stocks?
So those are expected to grow much faster than average.
Okay.
They could be in newer industries.
Okay.
Or have innovative products.
So like Tesla or Amazon.
Exactly.
Yeah.
They can be more volatile, though.
Yeah.
But also potential for bigger returns.
Higher risk, higher reward.
Precisely.
And income stocks.
Yeah, those focus on providing income through dividends.
So it's like getting a regular paycheck.
It is.
But from your investments.
Exactly.
Okay, and then the penny stocks.
Ah, yes, those are the risky ones.
I know.
Kagan definitely advises caution.
Yeah.
Those are shares of very small companies.
Okay.
Very low prices, incredibly risky, low liquidity.
Hard to buy or sell large amounts.
Right.
Without affecting the price.
And they can be targets of scams too, right?
They can, so definitely not for beginners.
All right, so we've talked about the types of stocks.
Yeah.
What about those exchanges where they're traded?
Oh, right, like the NYSE and NASDAQ.
Kagan talks about those.
She does. The NYSE, that's the oldest and largest stock exchange in the U.S.
Okay.
Known for its trading floor and very strict listing requirements.
Okay. Very traditional.
Very traditional.
NASDAQ,
that's newer.
Okay.
All electronic.
Right.
Focuses on technology and growth companies.
Got it.
So just by knowing where a stock is traded, you can get some insights into the company itself.
What about dividends? Kagan mentions that not all companies pay them.
That's right. Some companies choose to reinvest their profits.
Okay.
Instead of paying them out to shareholders.
Right.
Maybe they want to fuel growth.
Makes sense.
Or they just don't have enough profits yet.
To share.
So if I'm looking for income, I would want to find companies with a history of paying dividends.
Exactly.
If I'm looking for growth, maybe dividends aren't so important.
It depends on your goals.
Yeah.
Now, Kagan also introduces this concept of total return, which considers both the increase in the stock's price and the dividend income.
So it's the whole picture.
The whole picture.
All sources of potential profit.
Exactly.
Okay, now what about bonds? I remember learning about those.
Bonds. Those are loans that you're making
Yeah.
to corporations or governments.
Oh, okay.
So you're lending them money.
For a certain period of time.
For a fixed period
All right.
at a set interest rate.
All right.
And they promise to pay back that principal amount when the bond matures.
Like an IOU, but with interest.
Exactly. And they make regular interest payments over the life of the bond.
Got it. Why would a company or a government even issue a bond?
To raise capital.
Okay.
Maybe they need to fund new projects. Or expand operations.
Makes sense.
Or cover budget deficits.
Okay, so the bond market's pretty big then.
Oh, it's huge. Lots of different bonds out there.
What are some of the key things I need to know about the different types?
Well, maturity date is a big one.
Okay, what's that?
That's when the principal amount is due.
Okay.
And bonds can have maturities from just a few months to 30 years or even more.
Okay.
Then there's the interest rate.
Oh, right.
Also called the coupon rate.
Right, so a higher coupon rate means more interest payments, right?
Exactly.
So choosing the right bond depends on how long I want to invest.
It does.
And my risk tolerance.
Right, because there's also credit quality.
Okay.
Which reflects how likely the issuer is to repay.
Right.
And credit rating agencies.
Like what, Moody's and S&P?
Exactly.
They give bonds these ratings.
They do.
Based on the risk?
It's on the risk of default.
So a high rating means it's safer?
Yes, like a AAA rating, considered very safe.
And a low rating?
More risk.
More risk.
Higher potential return, but also higher chance of not getting paid back.
It's like a credit score for bonds.
Exactly. It helps investors assess the risk.
And Kagan mentions this yield to maturity thing.
Right. That considers all the cash flows from the bond, including the principal repayment.
Right.
So it's a more accurate measure of return.
They're just looking at the coupon rate.
Exactly.
It's like the total profit you can expect if you hold the bond until it matures.
Precisely.
Anything else I should know about bonds?
She also talks about interest rate risk.
Okay.
Especially with long-term bonds.
Right. Because if interest rates rise, bond prices fall.
Exactly.
So if I buy a bond with a low coupon rate and then interest rates go up, the value of my bond goes down.
It can. That's the risk.
Okay, now what about those U.S. government bonds?
Oh, those are often called treasuries.
I've heard that.
Considered very safe.
Okay.
Backed by the full faith and credit of the U.S. government.
So low risk, but probably lower returns too, right?
That's the trade-off. You have your treasury bills or T-bills.
Okay.
Those are short-term treasury notes, maturities from 2 to 10 years.
Okay.
And treasury bonds, those have 30-year maturities.
Yeah, I did.
So you can choose based on your time horizon and your risk tolerance.
Now, what about corporate bonds?
Those carry more risk than treasuries.
Okay.
But also potential for higher returns.
Got it.
You need to assess the company's creditworthiness.
So look at their credit rating.
Exactly. Higher ratings, those are investment grade.
Okay.
Lower ratings, those are speculative grade or what they call junk bonds.
Okay, so just like my personal credit score.
It is.
Bond ratings give you an idea of the risk.
Exactly. It's all about understanding the risk.
What other types of bonds are there?
Kagan mentions municipal bonds.
What are those?
Those are issued by state and local governments.
Oh, okay.
Often offer tax advantages.
Interesting.
The interest income might be exempt from federal income tax. Wow.
Even state and local taxes? Sometimes.
That sounds pretty good.
It can be.
What about those high-yield bonds?
Or junk bonds, as some people call them.
I know they're riskier.
They are.
But I've heard they can have good returns.
Higher yields, yes.
Why is that?
They're issued by companies that are more likely to default.
Oh, I see.
So they have to offer higher yields.
To compensate for the risk.
Exactly, to attract investors.
So the bond market is just as diverse as the stock market.
It is. It's a whole world unto itself.
Now, what about mutual funds? I'm really intrigued by those.
Yeah, a lot of people like those.
It's the professional management part that I like.
Right. Someone else is making the decisions.
Yeah.
Diversification, professional management, convenience.
Kagan talks about how they got started back in the early 20th century.
She does.
And how they become so popular.
Especially for retirement plans.
The 401ks and stuff.
Exactly.
It's an easy way to diversify.
It is.
And let someone else handle it.
And she explains this concept of net asset value.
Oh, NAV, yeah.
That's the per share value of the fund's assets.
So if the value of the investments goes up, the NAV also increases.
Exactly.
And mutual funds are easy to buy and sell.
Very liquid.
Okay.
You can get in and out pretty easily.
Now, what are the different types of mutual funds?
So many.
So many.
You've got your stock funds.
Okay.
Also called equity funds. They mainly invest in stocks.
Right.
Bond funds.
Okay.
Balanced funds, those invest in both stocks and bonds.
Okay, so it's a mix.
A mix.
And then target date funds, those are for retirement.
Those are geared towards a specific retirement date.
Got it.
So within each of those,
Yeah.
you have even more subcategories.
Like with stock funds.
Exactly.
There's growth, value, blend.
And index funds.
Right.
Each one has its own investment style.
So it's important to choose carefully.
It is. You have to understand
yeah.
what you're getting into.
And mutual funds charge fees, right?
They do, to cover their costs.
Okay.
Operating expenses, management fees.
Right.
Can vary quite a bit.
So pay attention to those.
Absolutely.
Kagan says they're expressed as an expense ratio.
Right, a percentage of the fund's assets.
So it's the annual cost of owning the fund?
Exactly.
It comes out of the returns.
Right, so a higher expense ratio means less money for you.
Okay. Kagan has some tips for choosing mutual funds, right?
She does. She says you got to understand your goals.
Right.
Consider the fund's investment style.
Okay.
Look at its track record.
Right.
Research the fund manager.
Their experience. Got it.
And of course, pay attention to those expense ratios.
It's like doing your research.
It is.
Before you buy something big.
Absolutely.
Make sure it's the right fit.
And that you can afford it.
Now, what about ETFs? Those seem to be getting really popular.
They are. ETFs, exchange-traded funds.
Right. They're similar to mutual funds.
They are, in that they offer diversification, professional management, but they trade on stock exchanges. So you can buy and sell them throughout the day.
Exactly, like individual stocks.
More flexible than mutual funds.
More flexible.
Okay.
And also potentially more tax efficient.
Yeah,
Typically, they generate fewer taxable capital gains distributions.
Now, Kagan says ETFs usually track a specific market index.
Yes, like the S&P 500 or the Dow Jones Industrial Average.
So you're investing in a basket of stocks.
Exactly.
That represents a particular segment.
Right. So there are broad market ETFs, sector ETFs, bond ETFs, international ETFs.
Yeah, so many options.
The whole world.
And Kagan has some tips for choosing those too, right?
She does. She says you got to know your goals, your risk tolerance, your time horizon.
Okay.
Research the ETF's underlying index.
Yeah.
Look at the expense ratio.
Okay.
And the trading volume.
Got it. So basically, do your research.
Always do your research.
I'm sure it's a good fit.
And that you understand the risks.
Now let's talk about real estate.
Okay. Real estate. Everyone loves talking about real estate.
It's a big one.
It is.
And there's so many opinions about it.
Oh, so many.
So what are some of the things I need to know?
Well, it can be a great investment.
Okay.
But you got to understand the risks.
Right.
Kagan talks about different ways to invest.
Like what?
You could buy rental properties, flip houses, or invest in REITs, real estate investment trusts.
Right.
Each one has its own pros and cons.
So with rental properties, you get that income from rent payments.
Right. But you also have to manage the property.
Right. And flipping houses, that's riskier, right?
Yeah. You got to know what you're doing.
You need expertise in real estate.
And construction.
Yeah. And REITs, those are like investing in real estate without the hassle.
Exactly. You're not directly owning or managing property.
Right. They own and operate income-producing real estate.
Shopping malls, office buildings, apartments.
Okay.
So Kagan says do your research. Before you jump into any real estate investment, look at location.
Yeah.
Property condition.
Right.
Market trends.
Look at it.
Potential rental income or resale value.
Location is key, right?
Location, location, location.
That's what they say.
It's true.
And it's good to work with professionals.
Always a good idea.
Real estate agents.
Yeah.
Property managers.
All the experts.
They can help you navigate those complexities.
Okay, now let's talk about some of those other investment options.
Right. Which ones are you thinking of?
Currency trading always sounds so mysterious.
It's definitely more complex.
What exactly is it?
Well, it's also called Forex trading.
I've heard that.
And it involves buying and selling currencies.
On the foreign exchange market.
Exactly.
Okay. And the goal is to
profit from the fluctuation.
Between the currencies.
Right. Trying to predict which currencies will go up or down.
That sounds hard.
It is. Very speculative.
And risky.
Very risky. Those exchange rates can change rapidly based on all sorts of things.
Economic factors, political factors, social factors, you name it.
Kagan says it's mostly done online these days.
It is through online platforms.
And people use leverage.
They do.
Which can amplify your gains.
But also your losses.
So even riskier.
High risk, high reward, definitely not for beginners.
What about commodity trading?
Commodities. Those are raw materials.
Like oil?
Or gold. Exactly. Or agricultural products like coffee or wheat.
So you're betting on the prices of those things.
Trying to predict which way they'll go.
What affects those prices?
Supply and demand.
Okay.
Weather patterns.
Oh, right.
Geopolitical events.
So it's like predicting the weather.
It is.
But for coffee beans.
Exactly. And you often trade commodities through futures contracts.
Exactly.
It's an agreement to buy or sell a specific commodity at a set price on a future date.
So it's like locking in a price today
Exactly.
for something you'll get in the future.
Right. So producers can protect themselves.
From prices dropping.
Right. But there's risk, too.
If prices go up?
If prices go up, you're stuck with that lower price.
Okay. Kagan also talks about options and futures.
Ah, yes. Those are derivatives.
Okay. I'm still a little fuzzy on those.
Options give you the right,
but
not the obligation to buy or sell something at a specific price by a specific date.
So it's like having a reservation
It is.
at a restaurant.
You can choose to dine there,
Yeah.
but you don't have to.
Okay. I get that.
Futures are similar,
Okay.
but they're binding.
Oh, so you have to buy or sell.
Exactly, no matter what.
So that's more like buying a plane ticket.
Yeah.
You're committed, whether you want to or not.
Exactly. Options and futures can be used for hedging.
Hedging? What's that?
Protecting yourself from price swings.
Okay.
Or for speculation.
So trying to profit from the swings.
Right, but they're more complex than just buying stocks
Definitely.
and bonds.
So the investing world has something for everyone.
It really does.
From the very cautious to the risk takers.
Find what suits your personality.
Kagan says it's all about finding what matches your goals.
Exactly.
Your risk tolerance and your time horizon.
Those are the key factors.
Now let's talk about planning for education and retirement.
Ah, yes, those big goals.
Yeah, they can feel overwhelming.
They can, but Kagan breaks it down nicely.
Yeah.
She covers those savings plans.
Right. 529s, ESAs, 401ks.
Exactly.
And especially the importance of starting early.
Can't emphasize that enough.
With those 401ks.
Yeah.
Getting those employer matches.
It's free money.
Yeah. Can't beat that.
And Kagan highlights the power of compounding.
Compounding? What's that again?
It's like a snowball rolling downhill.
Okay.
Your earnings on your investments generate more earnings.
Okay.
And so on. It just keeps growing.
What about socially responsible investing? I'm curious about that.
Ah, yes, SRI.
Kagan talks about that a bit.
She does. It's about considering your values.
Right.
When you invest.
So environmental impact, social justice, those kinds of things.
Exactly. Supporting companies that are doing good.
And avoiding the ones that aren't.
Right. So you might screen out companies that pollute or that make weapons.
Right. Or you might invest in companies that are promoting clean energy.
Or sustainable agriculture.
It's like voting with your dollars.
It is. You're supporting the kind of world you want to see.
And there are a lot of SRI funds out there now, right?
More and more all the time. Yeah. Mutual funds, ETFs.
Makes it easier to align your investments with your values.
Absolutely.
That's encouraging.
And research suggests that SRI doesn't have to mean lower returns.
Oh, that's good.
You can do good and do well financially.
Now I'm ready to talk about building my own portfolio.
All right, the grand finale.
It's like putting all the pieces together.
It is. So in the next part,
yeah,
we'll walk through Kagan's framework for building a solid investment strategy. All right, so we've covered a lot of ground. We have.
From those economic indicators to all those different investment options.
Stocks, bonds, mutual funds.
Even some of those more exotic ones.
Right, right.
Now, how do we actually build a portfolio?
Yeah, that's the big question.
Where do we even start?
It can feel a little overwhelming.
It can, but Kagan has this step-by-step approach in Investing 101. And she starts with the foundation. Understanding your risk tolerance.
Right. We've talked about that a bit.
We have.
It's not just about how much money you can afford to lose.
No.
It's about how comfortable you are with the ups and downs.
Volatility.
With the market.
Some people love it.
I know. Some people thrive on it.
And some people, it keeps them up at night.
Exactly. So
Kagan has some good tips.
Yeah.
For figuring that out.
It's not just a gut feeling, right?
It's not. You can actually quantify it. Based on your age, your income.
Your
financial goals.
Right.
How long you plan to invest. So like a younger person.
Yeah.
More time to recover from losses.
Right.
Might be more comfortable taking risks.
Might be.
Someone nearing retirement. Probably not so much.
Exactly. And then once you understand your risk tolerance, you need to define your investment goals.
This is where we get specific.
This is where the rubber meets the road.
Yeah. What am I actually trying to achieve?
What are you hoping to achieve?
Saving for retirement.
It'd be.
Buying a house. Kids' education.
Yep.
Or maybe something totally different.
Yeah, like starting a business.
Or traveling the world.
Exactly, those clear goals.
Yeah.
They give you a target.
Right.
Help you stay focused
Yeah.
when things get bumpy.
And it's not just about what you want to achieve.
Right.
It's about when.
That time horizon is crucial.
Yeah, that makes sense.
For choosing the right investments.
So if I'm saving for retirement 30 years from now,
okay,
maybe I have more stocks.
Yeah, potentially.
Because they usually have higher returns over time.
Historically, yes.
But if I need the money in 5 years.
For a down payment?
Yeah, for a house.
Okay.
I'm probably going to be more conservative.
Exactly. You don't want to take on too much risk.
Right.
So now with those goals and time horizons in mind, we come to diversification.
Ah, yes, the don't put all your eggs in one basket principle.
Exactly. Spread your investments.
Across different asset classes.
Different industries, different countries even.
Right, to reduce the risk.
Reduce the risk and also
yeah,
take advantage of different market conditions.
Oh, I see.
Some asset classes do well when others struggle.
Right.
So diversification smooths things out.
Okay, so how do I actually create a diversified portfolio?
Well, Kagan talks about asset allocation.
Right.
That's determining what percent
of my portfolio.
Yeah, it goes to stocks, to bonds, to real estate,
right.
to whatever else you're investing in.
Finding that balance.
The balance, that's right for you.
That aligns with my goals, my risk tolerance.
Your time horizon, exactly.
She also says you need to review
yes.
and rebalance your portfolio.
Regularly.
Why is that?
Because things change.
The market changes.
The market changes, your life changes.
Right.
Maybe your risk tolerance changes.
Yeah.
So you need to make sure
my portfolio still reflects that?
Exactly. You might need to sell some investments.
Okay.
Buy others.
To get back to that.
Get back to your target.
It's like making sure the wheels on your car are aligned.
Great analogy.
Keeps you going in the right direction.
Keeps you on track.
Along with diversification and rebalancing, Kagan also talks about patience and discipline.
Those are so important.
I know, but the market can be so volatile.
It can.
Makes you want to react.
Yeah, it can be emotional.
It can.
But Kagan says don't make impulsive decisions
right.
based on fear or greed.
Stick to the plan.
Stick to the plan. Remember your goals.
Long-term goals.
Exactly. It's a marathon, not a sprint.
And she emphasizes that it's important to keep learning.
Always be learning.
About investing.
The market's always changing.
There are so many resources out there.
There are books, podcasts, websites.
Financial advisors.
You can always find information.
Okay, so before we wrap up
yeah.
this deep dive, I want to share this quote from Kagan.
Okay.
It really resonated with me.
Okay.
She writes, investing is not just about making money. It's about taking control of your financial future and creating a life of abundance and possibility.
Wow, I love that.
It's not just about the numbers.
It's about your life.
It's about taking ownership.
Yeah.
And creating the life you want.
It's empowering.
It is.
So Kagan's book,
Investing 101,
gives you the tools to make that happen.
This has been such an incredible journey.
It has.
We've learned so much.
We have, from those basic concepts to some really in-depth stuff.
Yeah, I feel so much more knowledgeable.
That's
and confident about investing.
That's what we want.
So, to wrap things up.
Yeah.
Remember, take action. Keep learning.
The journey never ends.
And here's a final thought for you.
Okay.
Imagine you could have dinner with one of those investing legends.
Oh, the dream.
Benjamin Graham, Warren Buffett,
Peter Lynch,
Jack Bogle.
So many great minds.
Who would you choose?
Ooh, that's a tough one.
And what one question would you ask them?
Let us know.
On social media.
We want to hear your answers.
Happy investing, everyone.
Happy investing.